Last session today for the conference. We're going to talk about the global capital markets. If you have questions about are we at the peak or past the peak of the cycle, where are we going to invest this year, where are we going to find value, all these answers will be, if not answered, these questions, if not answered, at least discussed with our panelists. All together, we're going to put a little bit of pressure on them to reveal their secrets about their investment strategies, and we hopefully will have an interesting discussion. So I would like to welcome Peter Ballon, Managing Director of and Global Head of Real Estate Investments for Canada Pension Plan Investment Board. Hi, Peter. Hello. Christoph Schumacher. Hi, Peter. Who is Global Head Real Estate Managing Director and Board Member of Credit Suisse Asset Management. Hello, Chris. And Owen Thomas, CEO of Boston Properties, a US REIT focusing mainly on offices. So welcome. Please feel free to start sending questions through, and we're going to have a couple of polling questions as well. So we heard today a lot of things about starting with the economy and the cycles, and I think one of the burning questions the last 2-3 years is: are we at, close, or past the peak? Peter.
Well, I think it's easy to say we're not at the trough. You know, in maybe a European context, you could say we're closer to the peak. There's no doubt about it. But, you know, as an investor, you have to look at alternative investments. And while perhaps core real estate would be considered very close to the peak, it's hard to say that logistics is close to the peak. It's hard to say that India and Brazil and China are at the peak. So I think it depends what you consider your investment universe when you think about the peak. We think there's still some opportunities to make money in real estate.
Okay, we'll come back to looking into these opportunities. What do you think, Chris?
So, with regards to the US, I think the market is already softening, and it's pretty exciting to look into the US market. Europe, it depends a lot on the interest rate we see here, and being a Swiss-based company, we have been on a peak for a while, and the returns are very low have been low for longer, for a very long time. I would say it depends again what kind of asset class, what kind of city actually, but I wouldn't be too pushy on Germany anymore and rather look into other places like Poland, where we still have a certain opportunity still to develop.
Okay.
But yes.
Owen, Chris said that he feels that the US is softening and he finds it interesting. What do you think?
I don't think it's softening. You know, in our business, you know, you focus on two things: economic growth and cost of capital. And economic growth is not buoyant, but it's fine. You know, it's 2% plus or minus, and that creates confidence for businesses to take risks, grow, add employees, and lease office space. So I think it's healthy. And then on cost of capital, I mean, rates are 1.6, 10 years at 1.6. I mean, the expense of raising capital right now is incredibly low. Dr. Sri Kumar this morning predicted that rates are going to go down in the United States this year. So we're pretty confident in the market environment in the United States.
Nevertheless, our economists also urged us to think about scenarios, to be prepared. Have you factored this into your strategies at all? And can you give an example on maybe how you factored in the possibility of a downturn very soon?
I would argue most people aren't preparing for a downturn, as I see leverage ratios going up, which everyone's very tempted by the low interest rates, so it's a very natural reaction. But the truth is, everyone's levering up, which is also sometimes a signal that maybe we are getting closer to the peak. You could use that almost suggest as a leading indicator. I don't know if we're necessarily preparing for a downturn per se or a crisis, but we are using the opportunity to sell a lot in today's market.
Okay.
And we have a lot of capital still to deploy. Our fund is growing at a very rapid pace, and yet we were a net seller last year. And if things continue, we're on a fiscal year of March 31, so that's kind of my time frame. We're going to be a net seller this year too.
Okay.
And so if you could call that downturn preparedness, we're selling a combination of assets that we think will be a little less liquid in a softer market, as well as great assets that we think have, we can get a full price for.
Okay. And Chris, any contingency plans?
Sure, and just to be understood correctly, I believe in the US market, and I see these opportunities actually just now to go into that market. I see more and more American endowments and institutional investors going out of offices in the gateway city. They move into multifamily or logistic assets and leaving behind these gateway cities for us to come in. And I really see some of the opportunities there in cities like Boston, Washington, D.C., where we quite... Obviously, we have gone to Texas, Austin, Texas as well. Now, with regards to Europe, we try to invest on the existing portfolio and work on the assets. We have got 70 billion US under asset management, so we try to really develop a lot in the portfolio. We have got 1.3 billion under construction right now.
Under construction. So is this, we admittedly in most of the developed markets at least, we are seeing record low yields, the yield compression prospects are limited. So how do we find value? Do we find it through development mainly? Chris, is that a way of creating value in this
It's not only, well, look, our main strategy is core plus, value add, so it's not opportunistic, so it's not purely development. However, for the existing funds, we, for instance, we have got an entertainment center. We don't call it shopping center anymore, but entertainment center, where we develop a new resi tower on top of it, on top of actually the parking. And so we try to work on the assets, on the existing core plus assets. Yes, that's one strategy. And then, as I've mentioned before, like Poland, where you still find more, we're an office investor mainly. So we like office, and in places like Poland, yeah. For instance, to give an example.
Peter, Chris said that they're building residential on top of an entertainment center. You mentioned earlier the logistics, you feel probably they're already close to their peak. So if we were to think about sectors, what would you favor this year and why? Yeah. Or if you could give example of a sector in a particular country that you think
Sure.
it's...
Maybe I'll just comment it down if I can do my math. You have about 2% under development. We have usually about 10% of our portfolio under development, and that is how we're trying to get higher returns. No doubt, well, we think we're getting higher returns. The question is the risk profile, but we do think that's some way to make it. In terms of the sectors, I was saying I don't think logistics is at its peak just yet. I do think there's a lot too much capital flowing into the sector. So I'd say for some of the product, there are some newer investors to the sector that I don't think, in my humble opinion, that they're differentiating between quality yet. It's a sector call, and it's a smart sector call, but I think there will be some people that might be losers in this. So we really, the quick answer is for sure of the major sectors, logistics has the most favorable fundamentals of the major ones, but we invest outside of the major sectors. We've invested in student housing in the past, and the opportunities were very interesting a few years ago. We find that space has gotten very exciting and very expensive. Data centers, there's obviously a lot of capital flowing to that. There's all sorts of complexity associated with that sector. So there's plenty of sectors to make money with as a sector. But we actually, when we look at sector calls, this real estate, and everyone in this room knows that, it's macro. You got to count country, city, sector, yes. But at the end of the day, you got to get your assets right. Yeah, in our case, we have to find the right partners. We've made this year our highest return will be in Brazilian shopping centers. I have both of my Brazilian shopping center partners here, unless they left the room. So, and no one makes money in shopping centers. But if you're in the right market, the right partners, etc., you can make money. We've done very well in office buildings in Leeds. I never thought I'd make a lot of money in Leeds office properties, but so it's a little dangerous to just make, to be honest, gross generalizations about sectors or whatnot.
Of course, the world is a big place, and every market is at its own point in the cycle, and it's different sectors. However, the common theme for the conference today is addressing the ESG topics. How does this impact you as an investor? Are there your strategies or your returns so far, Owen?
Yeah, so what we do at Boston Properties is a little different from my partners here on the panel. We are an investor. We do own primarily office buildings in gateway cities in the United States, but we're also an operator. So we manage all our buildings. We lease all our own buildings. We're also a big developer, so we are building 5 or 6 million square feet at any one time. We have a development department, construction department. So to answer your question, it comes in what we do with the properties. And so we invest extensively in upgrading our existing buildings to more energy efficient uses. And we also build buildings that are at the leading edge of certainly energy efficiency, whether it be the energy systems, the energy production, glass systems. So why don't we do all that? Well, first of all, we know it's the right thing to do, but we also think it's the smart thing to do. And the reason is increasingly our customers care about this. So, we own and built the Salesforce Tower in San Francisco. And, Salesforce talks more about the sustainability characteristics of the Salesforce Tower than we do. It's a LEED Platinum building, and they're competing for talent themselves, and their talent cares about the kinds of buildings they work in.
Correct.
So that's one of the reasons why we do it. The second reason is our cities and our communities. I mean, we work carefully and closely with all of our communities, and as I said, we're in coastal cities, and they all care deeply about climate change because they have and will suffer from it. So we want to be part of that conversation. We want to contribute. Third, the investors that we serve. We issued over the last 2 years $1.8 billion in green bonds, which was, I think, very helpful for the distribution of those securities. I meet frequently with shareholders of our company by the way, we're a listed company in the United States, S&P 500, New York Stock Exchange listed. I meet all the time, particularly here in the Netherlands, with shareholders that really care about this, and the reason they're an investor in our stock is not because of what we do, it's because of our ESG performance. And then lastly, as a leader of a team, which is incredibly important to our success, our people care about this. And I think Boston Properties is a more purposeful company because we care about this and do our best.
And does it pay off? Do you feel that it's only cost until now? Or?
No, it definitely pays off. I mean, I think there is an indirect payoff, which is some of what I described. The culture and ethos of the company is an indirect payoff. If our customers care about it, they're more likely to lease our buildings and pay us more rent, so that's a positive. If we're working carefully with our communities, they'll be more supportive of our projects. And then, if our director of sustainability was here, he would point you to, hundreds of millions of dollars that we've invested in our existing assets or in new buildings that had, a measurable payback to the company. So I think we get tremendous benefit from this, both indirectly and directly.
Chris?
You definitely have to take it into account. I just have been at Davos, and the impact is tremendously huge on us. And I give you an example, a negative example. We had this branch, the Credit Suisse branch, the bank had it, in Lausanne, and there were people playing tennis in that branch just to push pressure on Federer to end his contract with Credit Suisse, because we finance a number of old-style oil companies. Now, Greta distributed that and shared that to, I think, 4 million followers. What did Federer does? He said and declared, well, I might have to end the contract with Credit Suisse. So just to give you an example, the power not to be aligned with his needs, and I've got 3 little boys and they tell me the same thing, is something you can't do. 1 point. Secondly, the investors. We have got mainly European investors. They all have to apply to their sustainability report. They're not going to go into investments into old buildings. And then, you mentioned that, the tenants. You won't get tenants if you don't do anything. So what we did in our main European core fund is to work together with Siemens to work on all the maintenance costs and change it and make it more sustainable. And politics going to push into this direction. If we don't move, it's not only the EU, it's going to be the Swiss, the UK, and maybe even the American government who might push us into that direction.
And you?
I think I agree clearly the importance of ESG. That certainly here in Europe is an established premise. I would take a slightly different perspective in that I have yet to see the returns there. I don't think there are higher returns per se, but given that I'm partners with Owen, I'm glad
to demonstrate that
indirectly. So we're going to do that after this meeting. So I'm very excited. I don't disagree that they're there. They're not quite as transparent to me. But our perspective is that it absolutely reduces risk. And of course, we're looking at everything on a risk-adjusted basis. And so if you can keep returns constant and reduce risk, then we are winning. And there's no doubt in my mind that owning real estate that is not ESG friendly, compliant, etc., has a far higher risk profile. Already we're in a very illiquid asset class. They're running the risk that our asset will become essentially obsolete. We all talk about obsolescence in different ways. Well, the real estate that's not ESG friendly, compliant, etc., runs a risk of being obsolete. And that is a huge risk. And so we actually see no incompatibility then being with ESG compliant, focused, etc., with maximizing returns. We don't see any discrepancy between that, and so we're very supportive. It's not, to be honest, it's not the altruistic side of it. It's which I would like to do, but it's really the commercial side of it that makes perfect sense for our stakeholders.
If I could just add one thing, Christoph touched on it. So even though the U.S. federal government infamously is not supporting the Paris Climate Accords, cities and companies in the United States are. And if all the cities that we operate in, with perhaps one exception, have already legislated ESG guidelines on either carbon emissions or building construction materials. So for example, in New York City, there are specific carbon emissions per square foot limits that have been established by the city of New York. And by the way, you can hit the 24 targets by becoming more efficient. You cannot hit the 2030 targets without clean energy sources. And if you miss those targets, there are fines per square foot that landlords will pay. So it's going to happen whether it's done voluntarily or involuntarily through regulation.
Okay.
Just one addition. It's not only sustainability, but it's really the social impact and impact investing as well. So we definitely going to support Lisette and our initiative here. And I really recommend for you to do it as well, to really see what we need. Because the question is then, how can we answer to the demands or questions given to us by the governments? And we need to find a common view how we react.
However, there could be the challenge sometimes maybe to not be able to achieve some desirable returns. For example, the old buildings that we mentioned, obsolete buildings, old buildings. We are an old continent. We have so much stock that cannot be ignored. Nobody maybe wants to touch it because maybe there's not much money to be made, but we have to do something about it. Or the residential sector. It's a hot sector at the moment. However, the pressing need for affordable housing, I guess, squeezes the possibilities for returns. What do you think? How do you think these matters should be approached? Should we expect some sort of incentives from the public sector to work together with the public sector? Do you think investors should accept the lower returns for the sake of ESG principles? How do you think we should approach these issues?
Tough question. No, in general, I'm not a supporter of necessarily incentives. I do believe in more of a free market system, and I think it works in terms of your older building example. I think it works its way through the system. There's no doubt everything's driven by the customer ultimately. If employees, in the good olden days, people wanted nice, clean office space with, just, 4 corners and all that. People like space with character, etc. And so that it has to be from the bottom. If there's demand for that sort of space, developers will develop it, and people will pay a premium for that. And it will come out in the system and say, no, I'm going to pay a premium for good quality space. And yes, I want fresh air in that old building. By the way, the old building actually has windows that opens up. So I'm not always convinced that, it's necessarily inefficient or expensive, but let's assume it is. I do think the free market part of it can work out. It doesn't move as quickly, but it's ultimately us no longer as developers, but as users saying, no, I don't really want that. I want this, and I'm willing to pay a premium for this. And if they choose not, then people are just kind of speaking on both sides of their mouth. If they're willing to say, okay, I believe in ESG, but I'm going to go for that energy inefficient building to save 3 cents, well, then they're voting that way, and that's how I believe it can evolve.
Chris?
I disagree. Unfortunately, I think at least the European initiative is going to push pressure on us, and we will not be able to just leave it to the free market, which I would love to see, but they're going to move forward. And I told you, I've been in Davos. If you see all these people and putting pressure on us, on the industry, we are responsible for 30% of the carbon emission, and they're not going to wait for us, for the market. And you saw the declaration of von der Leyen for the EU, and we had this morning this Dutch representative of the Dutch government, and they want to work with us. So we have to really see the governments and the public body as a partner. And at least in Europe, I think we can't leave it all to the market, unfortunately.
I think you have some very serious market forces already at work in this area that are going to push business leaders and investors to, quote, do the right thing, which is going to become do the smart thing. Examples we heard this morning from APG, major pension fund. One of their major pension funds is saying we want to do 100% ESG investing or carbon zero investing by 2050. That's huge. It's already estimated that there is well over $30 trillion of equity assets that are invested in ESG strategies. Now, a lot of that, when you dig into it, is just, don't invest in the oil companies. It's exclusionary investing, but that's a lot, and that is going to change. When we did our green bond offerings, the first deal was 2 years ago. I'm going to get this a little bit off. 20% of the book was green bonds. We did one last year, it was $850. 35% were green bond investors. And then you got the insurers. They're by the way, we had a ULI meeting in Washington, trustees meeting last week. We had a very interesting presentation on all this. Insurers are starting to get switched on. They're just not going to insure your property, unless you're taking care of it. So I think market forces are going to have a big factor to help solve the problem.
Although I don't think that's necessarily, I agree. Yeah. I don't think it's showing up in the capital markets. If you want to look at the listed companies, retail shopping centers are not trading at a discount because they're not green. It's because people don't like the dynamics. Data centers are probably trading at the highest premium as a sector. And no one wants to give up their Netflix, even though data centers are a huge user and have a huge footprint. And so there's a little bit of a discord, from that exists.
And investment decisions, cyclical versus structural factors that determine strategies. I think probably we are moving on from just taking into consideration just the economy, as we learned earlier, as we heard earlier. But the structural factors play more important role in investment decisions today. What do you think? Which kind of big change could be just what we are talking about, the environment, is it the demographics, is what the younger population wants and affects the use of space. What do you see as the biggest factor affecting and causing change into real estate and real estate decisions, investment decisions?
I mean, it's not a new topic, but I think what has impacted investing more so than any is urbanization. And that's both in developed markets and in emerging markets. I recall when our colleagues in our Asia office were proposing investing in Japan, and this is about 10 years ago, our first reaction, not familiar with Japan, was the usual declining population, all of this demographics. And they said, yeah, that's true, but Tokyo's still growing. And as it turns out, Japan and logistics combined was a good combination. And so I think that trend has had a huge impact, and I don't think that's changing. I still think, the growth of cities, et cetera, has had a far greater impact than almost any other investment theme. Of course, lower interest rates, I don't know if that's had probably more impact on values, but if you want to talk about kind of fundamentals to real estate, urbanization, I think is the key.
Chris?
Yeah. Similar to Peter's point, really the infrastructure. If you look at the Greater Paris project, that's going to have a huge impact on real estate. And so I think, again, if we want or not, we're going to work a lot with the municipalities and cities as well as federal governments as well on these projects, and they're going to have a big impact on our investment style.
Look, I agree with what Peter said in terms of I would certainly put interest rates as a big driver, and I would certainly put urbanization as a big driver. It's why we picked the perimeter that we did. I would add a third, and I would put it in the category of the future of work. And this is a little bit of an office comment, but I think it impacts the other asset classes as well. What's going on with work? And we're in the middle of a revolution in jobs where many traditional white-collar job tasks are being automated. And that's not going to happen, that is happening. And what it really means is it doesn't mean that there's a whole segment of jobs that are 100% automated, but some of the tasks that all of us do are getting automated. We all know that. I'm sure you can relate to whatever you do every day, that is the case. So I think what's happening is that the traditional industries, and I would call those, law firms, architecture firms, financials, they are prosperous, but they're not growing in terms of headcount. So what's growing is all the companies that are creating these automations. So, look at least in the United States, and I'm sure you have it here too, Google, Facebook, Apple, Microsoft, these are the companies that are creating a lot of these applications and automations. So I'm not a fatalist on the whole job automation, but I think it's shifting to where those jobs are. So that has a big impact on real estate. And if, at least in the United States, and I suspect it's somewhat true here, I would say 100% of the net absorption of office space this cycle has been either technology tenants, life science tenants, which again is a new technology, and then co-working. And so that's a big driver, I think, in terms of how we think about where we want to invest our dollars.
So I find you value both, you take into consideration both cyclical and structural issues, given that interest rate is so important, but also the changes, the long-term changes. In relation to your comment about the future of work, we have a small poll that we could do now, which is about flexible offices, co-working space, since also you're focusing on offices. Yeah. Let's see what the audience thinks about the future of this segment. Okay. So definitely the majority believes that there is going to be more demand driven by, well, definitely not less demand, and that future demand will be driven by the need for flexibility, by the young talent expectations from their office space. less think that it's cost efficiency, and even less people think that it's a way to manage a little bit your expansion in relation to potential downturn, as it were. What share of your portfolio is flexible office space, and is it run by you or others?
Yeah, so a little bit of background on this. So the answer to your question is 2% of our office space is, quote, we call it shared workspace business. 1% of that is WeWork, and the other 1% is a combination of the other third-party managers and our own, which we call Flex by BXP. So it's about 2%. We're WeWork's second largest landlord, if you look at it the other way. So, by the way, I would have answered the question with the majority. I think that it's going to grow, and I think that is the reason. We segment the business into three. You got to look at the customer. The customer wants this product. There are three categories. There's the individuals that decided working at home or at Starbucks is boring and lonely, and so they want to be in these places. There's the little startup that doesn't really care that much about what they work in, and they really don't know what they're going to be in maybe 3 months, but certainly, maybe in a year. So they just want space and they want it quickly. And then third, and this is perhaps one of the more interesting ones, major corporations would want to procure a single-digit percentage of their space on a short-term flexible basis, and they'll pay a lot more than market rent for it. Okay. So you take those are three significant drivers. So we're convinced that the space will grow. It's about 2% of the office market in the United States. It's about 4% in New York, San Francisco. Okay. I think it's a little higher in London, and I'm not sure about other continental European cities. I do, however, think that the structure of the business is going to change. I think that the co-working companies are going to become more managers, and the capital allocation decisions are going to rest with the landlords. Okay. And we will be deciding where and when we want to have these spaces for whatever reason, and we will select, managers for that. And that might be ourselves, but it might also be these operators. And by the way, if you take WeWork, they have a 50% market share. That is huge, and they have a big opportunity. And by the way, they have a network benefit because they are talking to all the major corporations. When we talk to a major corporation, we can offer them a specific building in 5 cities. They can talk to them about space anywhere. So they have a network benefit. And so I think that, again, they're dealing with a lot of issues that we've all read about last year, but I think they have a strong opportunity.
Are you a believer in the strong fundamentals of this sector as well? Do you invest in this?
We do. First of all, we do have WeWorks as tenants in Dublin and in Frankfurt, and in Switzerland we do it ourselves. We have a program called Spoom, and that works quite all right. But the Swiss market is tiny and kind of closed, so WeWork, I think, didn't enter that market yet. I think we have to be aware that it's going to be a manager rather than a hospitality operator. And it's not a tech company, it's rather a facility manager. So the valuation of these companies, that's one issue, should be looked differently. And then as a landlord, I believe they have to be, competitive. So we need certain parental guarantees, bank guarantees to be supportive for that tenant.
Okay.
Just on that point, I do think we're going to find out very soon, because what we've seen now, even with WeWork's incredible market share and their success, there's a lot of great things that WeWork did. We all have to appreciate they were working with very low cost of capital, and you could argue negative cost of capital. And I would suggest that tenants have always wanted flexibility. It's nice to get space that costs €100 per square meter to build out and sign a 1-year lease. We all want that, and that's what WeWork was giving the customer, assuming they were going to stay. Landlords have always understood they don't like that dynamic. So how that shakes out economically, and I think the conclusion could be right, that it turns into a management model, but that will change. People like Starbucks. yeah, if I can get the same cool space, beer instead of coffee at the same price, I'm going to go there. If the price goes up, suddenly they're going to be back at Starbucks. So I don't, the demand is there. The economics, I still think that I need time to shake out.
Okay, it's understandable. It's a maturing sector. So we might see a few failures before we see big successes, I suppose. Maybe now to finish off with some focus on regions, cities, sectors. We have some polls before we hear what our distinguished panel thinks. Maybe let's see what the audience thinks first. So the next poll, please. Wow. Nice. That's perfectly diversified.
You're the moderator. You're going to have to explain that.
Perfectly diversified. Wow. I didn't expect. I thought it would be 30% offices, and I thought it would be 20% PRS. Goodness me. Okay.
We have to survey the audience.
Good stuff. Affordable housing. Now, I think this is a pressure. Yeah. This is an indirect pressure on you. This is not, they don't have the money, you have the money. So, they don't care. Yeah. So they're telling you, you have to do affordable housing because that's what society thinks, which is perfect. It matches the ESG and everything.
Yes. We do affordable housing.
You do?
Yeah, we can't.
I thought you do on your offices.
We can't build a building without doing affordable housing. Okay. So we got an entitlement in San Francisco recently for a 500,000 square foot office building, and to get that, we gave a site. We gave part of our site for an affordable housing project. So that's the way new development is funding affordable housing.
And you can still, your shareholders are also happy with that.
Yeah, it's part of our contribution to the city to get what our shareholders want. And we think we can, even providing that land as part of the project, we can still build the office building and create the proper shareholder return.
And Chris, maybe pick what do you think the best prospects for the next 12, 18 months in terms of sector? I would like you to combine it with a city or a country as well, because as we said, we cannot be a blanket approach.
Sure. I mean, I'm a traditional office investor, and at least in Europe, like in Paris or Frankfurt or Berlin, where the vacancy rate is below 2%, I still believe office is the thing to do. Having said that, affordable housing, obviously, flavor of the month, and like you, for instance, in Hamburg, we had to do and propose affordable housing in combination with other projects. Now, my shareholders as well, it's ESG, it is affordable housing, it's all about that. I mean, we have to see what we can do and what capacities one has. You hear me, I'm a bit astonished with the results, so I'm an office investor.
Okay.
I mean, I'm just adding up the numbers on. It's close to 70%, or maybe it's above 70% if you include student housing and PRS and all that. I mean, that in reality, that's a strong message from the audience, which is what we're seeing. I don't want to get too involved in social issues, but there's no doubt that housing is a concern of everybody. I would differentiate that as being necessarily the most prosperous place to invest necessarily.
Yes.
There's no doubt housing is a front and center, and again, I don't want to become too political in my comments. I spent time in Hong Kong, and affordable housing is the #1 issue for people. I do want to differentiate that necessarily from suggesting that's the most profitable place to invest, but where there's demand and government listening to comments like that and feedback like that the audience could be right. It's very possible.
And the next polling question, please. It's going to bring everything together now, maybe. Well, that's interesting, isn't it? Yeah. Because it's again a very diverse kind of a very diversified response between security and risk. Mm-hmm. And it makes sense at the point of the cycle we are. We want to be in safe, in places which have, like safe havens, you want to call them, core, whatever you want to call them. And then there is also seeking like some returns. You would go to the emerging, growing markets. Does it match your allocation globally?
I think your description is accurate. I mean, we see Europe as probably one of the safest environments. And I would talk about, people who are negative on Europe, to be candid, talk about the low growth. But the low supply risk in Europe is really unprecedented. There are markets in the US, like West LA, which would have similar restrictions. But I do consider Europe the least risky, and we're generalizing, of course, market to invest in. And I do think growth prospects in Asia, combined with scale, are Asia Pacific's miles ahead. In fact, just Asia, in terms of scale and growth prospects. Mm-hmm. Mm-hmm.
Again, I kind of disagree. If the question is most value, I'm a strong believer in North America and particularly the US. I think still it's such a deep market, and as I mentioned, we did these investments in Boston, Austin, Texas, and I see Europe being very expensive, very, very expensive, and so, I don't know, I again disagree. Or I would have signed North America.
Okay. Do I need to ask?
It's my old job.
I think that's his vote, Steven. I think he somehow got his votes in.
He was voting.
That was his vote.
He was trying to increase it.
10 years ago.
He was on his phone. I saw him.
Okay, good. Thank you very much. We are 10 seconds before the bell rings, and thank you for all your interesting discussion today. See you next year.
Thank you.
Thank you very much.